Hello everyone, and thank you for joining today's webinar, Help, I Have Negative Inventory. Your presenter today will be Chris Robinson, who is our Webgility on staff QuickBooks Pro Advisor. I just want to announce a little housekeeping. Everyone is going to be muted until the end of the presentation. If you guys have any questions, you can put your questions in the GoToMeeting questions area. You'll see if you expand your GoToMeeting dashboard, there's an area for questions. You can put them there. We'll be periodically taking questions as they pertain to a particular section that Chris is talking about. We'll take them then. All other questions we will take during the question and answer forum. All right, so without further ado, I will turn it over to Chris, and he will go ahead and get started.
Hello, everybody. I'll be doing this presentation about negative inventory. I'll be doing it mainly in QuickBooks Enterprise. If you use a different version of QuickBooks, that's okay, because these are basic accounting principles and workflow processes that apply to everybody. As a pro advisor who specializes in inventory and e-commerce, negative inventory is my biggest enemy. I've had many clients who vaguely knew that negative inventory was bad, but did not know exactly why. They also did not know how to fix their own negative inventory problems. If you are already experiencing problems with negative inventory and you're using Webgility to have hundreds or thousands of orders automatically pushed into your company file each month, this will only exacerbate the situation. Today I will cover the causes of negative inventory, how negative inventory impacts your company file, and what you can do to fix it. I'd like to go over some basics of inventory before we get started. Item receipts or bills are how you record new inventory entering your warehouse. Sales transactions, like invoices and sales receipts, are how inventory leaves your warehouse. A bill transaction will increase the inventory of your finished good while decreasing the inventory of the raw materials that make up that finished good. Inventory adjustments are used sparingly for shrinkage due to damaged goods, theft, or spoilage. Negative inventory impacts your company file in a number of harmful ways, the most obvious being that your inventory asset account on your balance sheet will be understated. Something that is not as obvious is that it will throw off your cost of goods sold. This is a quirk of QuickBooks that inventory received that increases the quantity of an item from negative to positive resets the item's average cost. Let's take a look at how this works in QuickBooks. So if we look at one of my items here, okay, so if we look here in my QuickBooks file at this item here, we can see when we go into it, the average cost here is $100. Now, to figure out the reason for that average cost, we'll look at the Quick Report. The Quick Report shows all the transactions that this item has been involved with. And the average cost is calculated from bills or item receipts that the item is on. We can see that we received in here 75 of this item at $30. We can see here that we received 50 of the item at $33. And way down here, we received 3 of the item at $100. Now, that doesn't really make sense. How did just this 3 at $100 increase the average cost up to $100? Well, let's take a look at what happened before this item receipt pushed the quantity into the positive realm. Let's adjust it to put the quantity back into negative. So now if we look back at this item and its average cost, you can see the average cost is closer to true, just over $32. What happened is when that item receipt pushes quantity from a negative to a positive, it increased the average cost or reset it to the $100, which is actually incorrect, and like I said, is a quirk of QuickBooks. So let's just look one more time at what happens if we adjust that item receipt to push the quantity back into positive. So if we go from 1 to 3 items, and we look back at the item again, we can see it reset that average cost back to 100. Now, the reason why you want your average cost to be as accurate as possible is it's one of the main things that's used on your profit and loss statement to figure out how profitable your company is. The profit and loss is basically your revenue minus your cost of goods sold and some other expenses to come out with your gross profit. So if your cost of goods sold are incorrect, how can you trust that your gross profit is correct? There's other reports in QuickBooks as well, like your item profitability report, that basically takes the price of your item minus the cost of goods sold to come up with the item profitability. So if your cost of goods sold are not accurate, you are not going to be able to gain correct insight into how well your company is running. Let's jump back into the presentation. So if your items have fallen into negative quantity, it is usually because of a mishandled item receipt or bill. What typically happens is that the sales team is gung-ho about inputting sales into QuickBooks, while the administrative task of entering a sales receipt or bill usually gets put onto the bookkeeper's pile of work and may not be considered a high priority. This is a workflow problem and can be fixed by making the input of the item receipts or bills that contain inventory items a higher priority on par with entering sales. Another way that the receipt of inventory can be mishandled is when your bookkeeper incorrectly enters bills containing inventory items. If we jump back into QuickBooks and look here at entering a bill, we can see there's two tabs on the bottom, an expense tab and an item tab. If you're entering a bill for inventory items, they should always go in this items tab here. You just select the item that's on the bill and enter the quantity. You never want to do the opposite of that, which would be entering just the amount of that item here and having it hit the inventory asset account directly. Because if you do that, the quantity of the items will not be recorded in QuickBooks. You'll just have an expense directly posting to the inventory asset account. Now, if we look here at the item list, we can see this item here has a negative amount. Now, I set this item up so I knew what to look for. If we look at the quick report, we can see that there is, if we look at the quick report, we can see why it's negative. We can see that there's a bill missing that should have had the quantity on it. So the best way to find that missing bill is with a custom transaction detail report. Now this is a very powerful report in QuickBooks that can help you find almost any information you're looking for. It's highly customizable. So if we go in here to Reports, Custom Reports, Transaction Detail, I'm going to set this report to filter for my inventory asset account. And I'm going to sort it by items. So select the item here, and sort by item. What this will do is show all transactions that hit the inventory asset account, and if there's one of those transactions that doesn't include any items, it'll float to the top, like this one here. So if I look at this transaction, I can see that this item, this 4726 beveled mirror, was just expensed to the inventory asset account rather than entered here in the items. Now, not only does this throw off your quantity, but it also makes your inventory valuation summary out of sync with your inventory asset account on your balance sheet. So let's take a quick peek at that as well. So if we go to our reports, inventory valuation summary, let's make this a little bit smaller. We go way down to the bottom. We can see that the total value of our inventory is $47,828. Now if we let's do this again. Now if we look at our balance sheet, see if we can pull them both up so we can see them side by side. Great. If we look at our balance sheet and we find our inventory asset account, right here, these two should match, but you can see they're off by a little bit. If I look back at this bill and I enter it correctly into the Items tab, not only am I going to add these items to my inventory, but I'm also going to sync up my inventory evaluation summary to my inventory asset account. So let's save this and refresh these reports. So now you can see these match up now that I've corrected that incorrectly entered bill. And if we look back at our item list, that item is now in the positive like it should be. And if we look at the quick report, we can now see that bill pop up in the items quick report. Let's go back into the presentation. Many times I see negative inventory in one of my client's company files because of an assembly item that is not set up correctly. Let's jump back into QuickBooks again. If we look at my item list, we can see that we have this bicycle right here that's at -4, and all the parts that make up the bicycle have high quantities. What happened is we keep receiving the parts that make up the bike, but we don't sell the parts, we sell the bicycle. So without having this be an assembly item, there's no way to link the raw materials to the finished good. So as you receive, the quantities will keep increasing of the raw materials, while the finished goods quantity will keep decreasing. Really, this should be an assembly item. Let's look and see how an assembly item is created. If we were to change this from an inventory part to an inventory assembly, just let us know it's not a reversible action. This area here for the bill of materials opens up. What I want to do is enter in all the raw materials that make up the bicycle, kind of like a recipe. So let's do that. So let's say we got 2 pedals, 1 handlebar, 1 frame, and 2 wheels. And that's all the parts that make up our bike. I'm going to set the cost of it to be the total BOM cost. That's going to roll up the cost of all these individual items. And let's now save this new assembly item. Okay, now that it's an inventory assembly, we can perform a build transaction. A build is how you convert these raw material bike parts into the finished good bicycle. So if we look at the build assemblies, we can choose a bicycle type item, and look here, this is the recipe or the bill of materials that I just created. So I'm not seeing any on hand because the date for this build is before I received the items, that the raw materials that make up the bicycle. So always be careful to have the correct date when you do a build. One second here, guys. I thought I had quantities in all these. Yeah. There we go. And so it shows that I can build up to 10 based off the quantity in the bill of materials. So let's say I built 8 bikes. Once I hit this, you can either hit build and close or build and new. Once I hit the build, if we look back at the bicycle item, we can now see that we have 4 bicycles on hand and that the quantity on hand of the raw materials has been decreased accordingly. So now we have fixed this negative inventory on this item that really should have been an assembly item, and also the inventory on its raw materials. Now let me hop back into the presentation. Anytime that you combine 2 or more inventory items to create a new item, that's an assembly. Something else that happens with assembly items is if for some reason you change a transaction that held one of those raw materials that makes up the assembly, you can throw your assemblies into pending builds. This is something that can be confusing for people wondering why their inventory got so messed up. So let's look at this fancy lamp item here. So this is an assembly item, and it's made up of all these parts. Okay. One of those parts is the bolt. Let's look at a quick report for the bolt. Let's say that your bookkeeper entered this bill that contains the bolt item based off an invoice that was received from your vendor. Later, shipping and receiving department let your bookkeeper know that the bolts on the shipment were damaged and that they had to be bought from a local hardware store instead to fulfill the outstanding orders. Your bookkeeper goes into QuickBooks and adjusts the bill to reflect that the bolts were not received from the vendor. So let's say she goes in here and deletes this line item out of this bill. Okay? So when she saves it, it's going to say here, oh, transaction is out of balance. Let's see, like 14, 19, 2000. So you're going to get this warning that this transaction is going to throw your builds into pending status, because what happened is that raw material, the bolts in QuickBooks, is not there historically to be used in those builds. So at this moment in time in QuickBooks, it doesn't have all the materials to perform the builds, so it undoes the builds you have already done and throws them into pending. So if your bookkeeper is not careful and doesn't pay attention to this pop-up and just clicks Mark Pending to get through this, if you look into your item list now, you can see when you look at the fancy lamp, oh no, now it's a negative number. Why is that? That's because all those builds that had been performed are now pending. If we look here at a report that is your pending build report, we can see all these builds here are pending. So even though your bookkeeper just wanted to go into QuickBooks, delete that bill out, and maybe enter a new bill, say they had to run over to Bikes R Us to buy those bolts. Okay. Say they had to go to the accounting firm to buy the bolts, and ended up getting 1,000 of them. You know what, I just realized that I didn't check the date on that one. Let's look back at that. Change the date to before when those builds were created. So now when we go to the pending build report, we'll be able to remake these builds. So we just want to remove the pending status and build it again. You just kind of have to go through and do that for each one. So the moral of this whole story about pending builds is be very careful when changing your bills or item receipts that contain parts that were used in builds. Let's jump back into the presentation. So once you've corrected your workflow processes that could be causing these negative inventory issues, you want to conduct a physical inventory count to bring your inventory up to an accurate level. Now, doing a physical inventory count is not as simple as just going into your warehouse and counting everything. One thing you will have to make sure to do is complete all transactions that need to be done in QuickBooks up to that date. So if you have any outstanding bills or item receipts or sales invoices, make sure those are all input and done so there's not a backlog of work. Also, any shipping or receiving that is being done needs to be suspended. I typically recommend clients do an inventory count into the day of Friday or over the weekend when outside of normal business hours. This is because if you try to do an inventory count and goods are coming in or leaving, you're trying to hit a moving target, which almost never works. The other thing you have to remember to do is count your inventory at all locations. Do you hold some inventory in a work vehicle? Is some inventory at one of your salespeople's houses? Do you have inventory on a showroom floor? All of that needs to make sure to be counted. Once you've counted everything, you can make that inventory adjustment. Let me hop back into the file. So say that we do an inventory adjustment for this fancy lamp because we realize, oh hey, we actually have 10 of these in stock. So we'll do this for, sure, the 19th. Your adjustment account should never be your inventory asset account, even though for some people that seems what would be appropriate. Typically you want to put it into some sort of an inventory shrinkage account. Which I should have set up, but I didn't, so I'm just going to throw this. Well, let's just pretend this is an inventory shrinkage account. So anyways, I do the adjustment to the new quantity of 10. When I save this, it's not really just a new quantity of 10 that it gets saved as. If you look back at it, it's a quantity difference of 9. It just added 9 of this amount on this date. So if you enter a transaction before this date, so we have 10, that's what we want, right? So if, say, you said, oh no, we actually had a sale that we forgot to input that happened the 1st of December. So we go here and create an invoice for the 1st of December. It's for 2 fancy lamps. Well, now we'll see the quantity is actually 8. It disrupted that inventory adjustment we made. So what I recommend people do after they do a physical inventory count and make an inventory adjustment is to go here to Edit, Preferences, and in your accounting section under Company Preferences, you can set a closing date with the password. You'd want to set that date to whatever the date was of your inventory adjustment, and then set a password that only you know. Then if your bookkeeper or whoever or a salesperson tries to enter a transaction before the date of your inventory adjustment that would throw off the inventory adjustment, they have to consult you first so that transaction can still be entered, but you'll know to adjust the inventory adjustment accordingly. So as you can see, there's a reason why I say use inventory adjustments sparingly, because they can start to get very confusing very fast. To summarize the topic, you want to make sure that first you correct the workflow processes that you have that are creating the negative inventory in the first place. Whether this is bad timing of entering item receipt for bills that contain inventory, whether it's because you're not creating billed transactions correctly, or the timing of those billed transactions are incorrect, or if it's because you're misusing inventory adjustments. Once you've corrected those workflow problems, do a physical inventory count of all your inventory. Make sure you do that physical inventory count properly. Once that's done, what you can do is periodic cycle counts of maybe one section of your warehouse. The cycle count should match up to your inventory now that your workflow problems have been fixed. If it doesn't, you can then research what's going on to cause those discrepancies and tighten up those workflows even more. It may take a couple months to get everything back on track, but you at least will have a roadmap now to get out of negative inventory. That concludes my presentation. Okay, I hear that I have 2 questions. Here we go. So if one of them is, if using FIFO with advanced inventory instead of average cost, does negative inventory still create problems with the profit and loss statement? Yes, that it definitely does. So FIFO is a first in, first out costing method. And what it does is it creates layers of cost that QuickBooks looks through. So say you receive 10 items at $10 and then 5 items of the same item at $5. So as you're selling the items, the first 10 items you sell will have a cost of goods sold of $10, and that 11th item will have a cost of goods sold at $5. Okay, then you burn through those $5 items as well and sell another 10 items. Well, what cost is QuickBooks going to look to find if you're selling items that haven't been entered and added a new layer to your FIFO costing layer? Well, it's going to still be selling them at that $5, even if you had received them again at that $10 mark. So it doesn't matter if you're using average costing or FIFO, negative inventory still distorts your cost of goods sold. I have another question here from, oh sorry, and that question was from Shin Lee. I have a question from Carl McGuire. What is the difference between a group item and an assembly item? Here, should I share my screen? I'm not going to go to QuickBooks for this one. Basically, an assembly item are items that get put together to make something. A group of items is like a bundle of items that are commonly sold together. So the bicycle's an example of an assembly item. A group item would be like maybe a gift basket. And the main difference is that the raw materials and the bill of materials for an assembly item gets deducted whenever you create that build. So whenever you build a bicycle, you pull the parts off the shelf, build the bicycle, then have that finished bicycle good put back on the shelf. Whereas a gift basket, the raw materials don't get deducted until you actually have an invoice. So there's no build happening in advance. When you get the invoice for the gift basket, at that time you go and pick all the items that go in that gift basket, put it in the box, and ship it to the customer. So it's a timing issue of when the items get pulled out of your inventory. I have another question from Vicky Lapp. Is the presenter available for private consultation? Yes, I definitely am. You can contact me here at WebGility. My phone number or my email address is chris@webgility.com. That's the best way to contact me here. You can buy a block of hours for me to work with you, and you have to use 1 hour at a time minimum. And I can help you with whatever problems you have. Also, if it's just a quick call with a quick question, or you can do that. Also, I have the Ask a QuickBooks Pro Advisor section in the forums. So if you go into our forums and post your question in the Ask a QuickBooks Pro Advisor section, I will definitely answer it free of charge. Andy Rosenbaum asks, we have negative inventory for items that we sometimes drop ship. Later on, when they get fulfilled from the vendor later, it will go back to 0. Is there a better way to handle this? So If it's an item that you exclusively drop ship and it's going from negative to zero, and it's not an item that you actually physically stock, don't make it an inventory item. Make it a non-inventory item. A non-inventory item does not get tracked in your inventory, and it gets expensed at the time of sale, which that actually follows accrual accounting principles, because the only time you ever are going to be billed for or expensing that item is because of a sale. So what you want to do is, for those items that are being drop shipped exclusively, just change them to a non-inventory item. Great questions, guys. So Nisha Holiday asks, if I have two items that I break apart, but they also make a complete item, can I make the items that make an assembly? I think what you're asking here is if you can make sub-assemblies in QuickBooks, which the answer is a resounding yes. When I was showing you the bill of material for the bicycle, and I put in pedals, bicycle handle, tires, well, if, say, your gear assembly was another assembly, you could just have the line item be gear assembly, and that would be a sub-assembly of the bicycle. And QuickBooks definitely handles sub-assemblies. I also have a question here from Jamie from Texas Tactical Gear. What if you cannot enter all your missing bills from numerous years? Is it best to enter individual inventory adjustments for each year? I mean, you got to do what you got to do sometimes, right? If you can't do it, you can't do it. You have to realize, if those bills have different costs for the items on each bill, when you enter in that inventory adjustment, it's only going to have one cost. So there's a good chance that, again, your cost of goods sold is going to be distorted. Also, if it's been missing from numerous years, your books have been closed. Once books are closed for a year to pay taxes on it, you don't want to go in and make adjustments to that prior period. What you're going to have to do is make some journal entries in the current period to account for that. This is a much more complicated question, and I recommend, Jamie, that you get a hold of me personally. We'll take this offline, and I can better instruct you how to deal with that. Thank you for the question. David Hamani asks, can you please explain the group products again and how that affects inventory at the time of sale? Okay, I will try to go more in depth about the group item. So you got to remember, QuickBooks is reflecting what's happening in the physical world. So in real life, if you manufacture or do light assembly on items, like the bicycle example, when are you completing that build? Do you build a couple bikes and stock them on your shelf and have them ready for when you have sales? Or do you only complete the build at the time of sale? Either way, when you build a bike, that's when you want to perform that build transaction. So let's say that you have enough parts for 10 bikes, and you build 9 bikes, and 9 bikes are sitting on the shelf. Well, you want to know that your raw materials are almost out, so it can trigger a minimum reorder point so that you know to order more raw materials to be able to build more bikes. Whereas a group item, you're never going to build a group item in advance. They're just items that commonly get sold together. So you never have to worry about using a build transaction, and the only time that the inventory gets decreased from a group is when it's on an invoice or sales receipt. I hope that cleared that up for you. And again, if you still have questions about it, maybe this is something that we should do a one-on-one quick conversation, and I can answer whatever your confusion is. Okay, David Hamani asked again, for items that are already an inventory part, how can we change the item to a non-inventory part? It doesn't seem that we can do that with current items. Is that because we're in multi-user mode? So changing an item to a non-inventory item is a little bit more difficult than just making a non-inventory item off the bat. What you're going to want to do is first make sure that that non-inventory item has a quantity of 0. You do not want the item to have a negative quantity when you do this. So first do an inventory adjustment, make the quantity of that item to 0. Then you want to change the name of the item slightly. Maybe put a -old after the item name, and then inactivate the item. Then you're going to go in and create a new item that's a non-inventory type item with the name you want. Carrie Taylor asks, can I use FIFO without having the advanced inventory module? That's a negative, Carrie. FIFO is one of the main features that is included in the QuickBooks Advanced Inventory module. That's something that's already built into QuickBooks Enterprise, but you have to pay $999 to have it turned on, basically. The main benefits of Advanced Inventory are that you have multi-location. You can track bins within those locations. You can use FIFO costing. You can use barcodes you can also use barcodes to scan in information. And those are the features you get with Advanced Inventory. Andy Rosenbaum asks, what's the best way to distribute inbound shipping costs to items COGS? So unfortunately, QuickBooks does not track landed costs for items. So if you wanted to track inbound shipping costs for individual items, there's not the way I know you want to do it, which is to distribute the cost of shipping based on weight or dollar value of the items. That's just not something that QuickBooks supports. So there's not a great way to do that, Andy. Good question, though. So Paula Latinga asks me, is Advanced Inventory module only available with QuickBooks Enterprise? That's correct. It is only available with QuickBooks Enterprise. Pro Premier does not have that ability, and QBO also does not have that ability. Okay, guys. Well, it looks like we've gone through most of your questions so far. Again, my email address is chris@webgility, and if you think of another question after this webinar, please post it in the Ask a QuickBooks Pro Advisor section in the WebGility forums, and I will definitely go in there and answer it as fully as possible. Okay, I have one more question. It looks like Tim Grant, who's famous in the inventory world, was on the line, and he said that you can post, for the landed cost, you can post the freight on the expense tab as a negative, and it will increase the cost of the items to offset it. Great. So that one's for you, Paul. Again, for landed costs, you can post the freight on the expense tab as a negative, and it will increase the cost of items to offset it. Thank you, Tim. Well, thanks everyone for joining me in the webinar. I know that you had to decide between this exciting presentation and the Germany versus USA World Cup game, so I'm quite flattered for all you that attended, and I'll see you next time.